Housing prices are on the rise, and so is the cost of living. Our paychecks are getting squeezed tighter and tighter every single month. It's time to face facts. A lot of us may not be able to afford to buy a house, especially when we're young. Join me over the next 4 weeks. We'll be doing a 4-part series called Can You Afford to Buy a House? Here we're going to explore the hard facts about what you need to actually be able to get a house you can afford, and also provide some relief that maybe renting isn't the worst financial decision in the meantime. Welcome to part 1 of Can You Afford to Buy a House? Today we're going to be talking about the down payment. How much do you need to save up in order to be able to buy? So have you heard of this thing called the 20% rule? It's important. In order to qualify for a conventional mortgage, you need 20% of the market value of your house as a down payment. This means if you want to buy a $300,000 house, you'd need to save up $60,000 in order to qualify for the 20%. That's a lot of money. So a lot of people don't put down 20%, but that can be costly because of this little thing called mortgage insurance. In Canada, you can actually put down as low as 5% of the market value of your house, and in the US as low as 3.5%. That's pretty risky because if you think about it, the bank owns 95% of your house, if not 97%, which is why you're going to be charged mortgage insurance. The less money that you put down, the more mortgage insurance that you're going to be charged. So what is mortgage insurance? It's the fee that you have to pay on top of your mortgage because you didn't put down 20%. So if you were trying to buy a $300,000 house and you had a down payment of only $15,000, that would only be 5%. Therefore, your total mortgage would be $285,000, and you're going to be charged mortgage insurance on that entire amount. And at 5% of a down payment in Canada, you'd be charged an insurance rate of up to 2.75%. That's $7,837 that's rolled into your mortgage, and that's a lot of money, all for the luxury of not waiting until you could save up enough to put down that 20%. And lastly, in addition to your down payment, you should also be saving 2.5% of the market value of your house for the other costs. Things like legal fees, home appraisals, land transfer tax, and the list goes on. Many times I see new young families that don't save up for this extra 2.5% and get sent with a huge bill. So in an ideal world, all of us would be saving a 20% down payment plus 2.5% for the extras for a whopping 22.5%. That's the ultimate goal. I know that that's not realistic for a lot of people, especially as housing costs continue to rise. Don't go lower than 10% down payment plus 2.5%. 12.5 is the lowest you should be going. So what unforeseen costs surprised you if you've bought a house? Let me know in the comments below so we can save everybody else the hassle. I'm Shannon and this is Money Awesomeness on Coral. Don't forget to subscribe, follow me on Twitter, and tune in next week for part 2 of our series. I'm going to show you how not to be house broke.